are we stretching central bankers to the point of breaking? Some of your colleagues, the former head of the Bundesbank, believes that it is quite obscene what central banks are now being asked to do. They have long since gone beyond their remit. They are now doing the job that fiscal policy is supposed to do. Where do you stand?
Well, first of all, it's too late to ask that question. We could have asked that several years ago. And then we would have two options, either to have a crash or a central bank support. We decided in favor of central bank support. We calmed the markets, we calmed the banking crisis, and we started to see some important structural and economic reforms. Now, today, to go back and say, this was all wrong, it's like starting the discussion about the euro and say it's not an optimal currency space. Of course it's not an optimal currency space, but this discussion we should have had 20 years ago, and not yet. So in my view, there's no alternative to that. We have to continue, but we have to see that we start the exit strategy as quickly as we see inflation expectations being built up and the economy becoming stronger. And that is the big issue. Will we do that? Will we have the courage to do that at a very early stage? And that will be the key test which we have to pass.
You believe it has to be, there needs to be courage to move before others might say now is the time.
That's always, if you talk to central bankers or retired central bankers, they very often say the courage will not be there. But given the clear mandate, it's a bit different in the United States, in Japan, and in other parts. But in Europe, it is such clear mandate is price stability. They must have the courage. I mean, otherwise they are violating their own rules.
Ben Bernanke has admitted this is an experiment.
Yeah, it is. I think, we have a lot of professors and academics in the room. I think no one knows what it really means in the long term. Does it mean that one day we will exit in a smooth way by announcing it in a very ordinary way, or as very often it happens, we will have a crash situation where inflation expectations are being built up, priced in bond markets, yields go up because of a more restrictive monetary policy, and you will have a 94 bond crash situation. No one knows. I mean, there is a tremendous risk, but is there an alternative? If governments are not willing and not capable because they have no support in their constituencies to be more expansionary, and I think it would be wrong, by the way, to move away from the Maastricht criteria even more, then you need the central banks to step in. Central banks are actually quite cleverly saying we do that only if we have the support of the government. So in that sense, it's not something which they just do on their own. I believe, because the mandate is so clear, especially in Europe, namely price stability, that we will see an exit strategy which works. But I have to admit that there is a risk that if the economy starts to recover faster, and people still think it's not, strong enough to exit the strategy, then you may have inflation expectations, and inflation would be the consequence. I still think that we will see that, and we will start absorbing the money as soon as possible. And I have to say one very important thing. So far, we have seen an asset inflation, and we have seen, of course, an inflation of the central bank's balance sheet, but it's not really gone into the demand for goods and services. That's why, and the credit supply of banks is still relatively small. That's why it's relatively easy to absorb the monetary base if they want to do that.
That shows that the monetary transmission mechanism is basically broken, or at least not functioning properly.
That's a big problem, especially because it's different in different countries. If you are in Italy or in Spain or in Portugal or in Greece, you pay more because it is true that the money transmission mechanism is not working as well as in these countries. That's why you have to be overly expansionary for these countries, whereas for Germany, where you have a relatively stable economic growth, probably a more restrictive monetary policy could be supported. Being now in the life insurance business, you would like to see a little bit higher interest rates. And of course, the same is true in order to prevent some sort of an asset bubble. I mean, you may have it. Look at the equities market, look at some of the bond markets, look how spreads have come down. How do you explain that fundamentally without saying, well, there is a tremendous liquidity provided by the central banks. And of course, is that the right thing? Are we paying a price for that longer term? I do not share that view. I think there's really no alternative option, and we have to go that course in order to help Europe as a whole. But it needs structural reforms now, and it needs a disciplined monetary or fiscal policy in these countries to get out of it.